on and let's talk about the fundamentals as well. And Ajay Bagga joins in on the show right now. Ajay, hi, afternoon. How is it that you're mapping the market mood? Resilient but not joyous?
No, I think resilient and optimistic is the shift after the exchange of pleasantries between Trump and PM Modi. I think that's the change.
All right, but along with that, Ajay, in the latest, we have also seen rupee hitting a fresh low for itself versus the dollar. And well, of course, Ajay, it's been a while that FIIs have been the net sellers, especially in the cash market. How do you see the rupee movement going ahead? Because while a couple of months back, we have seen the sharp correction coming in, and RBI really had to come ahead to really tighten the kind of volatility that we were facing that time. What are your views right now?
No, if you look at our current account deficit, it's not been ever better. Last quarter was at about 0.2% of GDP. FX reserves are going up. I think this is an orchestrated move where, in a very slow and steady manner, the RBI is allowing the rupee to depreciate to make the exports more competitive, to take away some of the sting of the tariffs. So I would not be very fessed up about this. You are seeing the FX reserves actually increasing. Overall, if you see the country's balance of trade, balance of payment, and current account balance, all three are pointing to a lot of robustness. Remittances are at very high levels. And guess what? Even July exports were strong because there was a lot of front ending before the US tariffs came in. Now, let's see what the August numbers show. But I would not be very worried on the rupee. And RBI has a calibrated mechanism, though officially we say that we don't manage the rupee. But you see a 2 to 3% depreciation happening in the rupee against the dollar. Of course, where euro or Japan or Swiss franc have been going up, we see the rupee as a declining currency. Yes, very much. But you have your FX reserves, which are showing that it's not a function of demand and supply. It's more a calibrated devaluation that's happening.
Right, Mr. Bagga, all this optimism and resilience that we're talking about, that we're expecting to see in the markets, as of now, we're seeing it only coming in from domestic investors because as FII flows are dwindling and they're looking weaker by the day, you have some show of support coming in on the DII front. But what could be the trigger for the FIIs to make a comeback because they have been consistent sellers for quite some time now?
About 1,500 billion of 1.5 trillion of FDI flows and FII flows happen in the world. We get a very small portion of it. But that portion has to be interested in India, has to be interested in that valuation. Then you find companies which can excite them, or you get country level ETFs, which again, it's not that the world is beating a path to India. We have all our what we keep on applauding ourselves, the best macro, the fastest growing large economy, great domestic consumption market. All those are factored in. But the issue is on the margin, money is not willing to come in at 23, 24 times forward earnings when the earning growth has been quite slow. So one, the earnings growth has to hit a bottom. Then we know that, okay, now we made a bottom and from here earnings should start going up. I think we have done that in the June quarter. We'll get to know in the next 3 more months. We'll get a better idea. September, of course, the numbers are a little on the muted side, but there's a lot of hope post the GST2 coming in that volumes will go up. That will help companies to also shore up their bottom lines as the top line goes up. So overall, the issue with FIs is your earnings growth versus the valuation. Valuation had run up, but now 12 months we have paid the price of underperforming. Normally around this time, you do see a turn happening. So between say 50, 55 weeks. Normally, you would see a turn happening. So it's a matter of time, I would say. What the catalyst will be, it might be Trump, it might be some leeway coming in on the tariff front. It might be some other reform being announced by the government. Some catalyst will come in. Earnings will take 3 to 6 months. You will start seeing that happening. September, again, a muted quarter is coming up, but it will be better than the June quarter. That's our estimate.
Okay, that's the take coming in right now. Patient could be. But Ajay, since you do track, global updates as well, soon enough you'll have the much-awaited Fed meet. It seems like after a long hiatus, they're going to be finally easing, and a 25 bips rate cut could be on the cards. But what does it do to the global, equity market flows? And do you think then in that case, money would move back to US equities in some sense?
Absolutely, Aisha, spot on. If you see the last 6 weeks also, there's a net positive flows into the US markets. And with the rate cut imminent, the attractiveness of the market goes up. Overall, if you see when rate cuts are done by the Fed in a non-recession US economy, the S&P 500 goes up for the next 12 months. So there's a lot of positivity about the future of the US markets, despite the narrowness of the markets. The top 7 to 10 stocks make up most of the earnings growth, make up most of the market cap growth. The valuations are not cheap at all. They are at the higher end of their overall average. So it is not a cheap market, but it's an exceptional market still. One, it's getting just yesterday, Goldman Sachs Family Office report was out. About 57% is the preferred investor outlook towards the US public equity markets. Within that, AI and technology grab the lion's share. So that exceptionalism is continuing. 2% GDP growth in the US looks quite doable. And the labor slowdown, the job slowdown that we have seen, a lot of that has also to do with a lower supply of labor in the market, as well as the policy chaos unleashed by the Trump administration. So overall, the big beautiful bill has to come in. So those tax concessions will come in. CapEx starts coming in over the next 12 months, and the deregulation. Along with that, if you did not need a rate cut stimulus, rather you're putting more fuel into a raging fire by cutting rates. But the labor report, the jobs report, has really put the consensus towards a rate cut. And now markets are factoring in 3 rate cuts. Let's see if those come. The other pleasant surprise has been the tariffs have not flown through into the economy. $88 billion of custom duties have been collected by the US. But the impact on, you saw the PPI numbers in the US, which is basically the wholesale inflation. That number was negative month on month. And today you will get the consumer number. We're not expecting more than about 0.3% month on month growth, and about 3% odd year on year. So we have not seen the flow through yet of the tariffs into the US economy. Again, what the Yale Budget Lab makes a calculation based on the weighted average US goods. Tariff collection should have been 18%, but it's coming in at 11%. So there are some concessions which are going through still, and you're not seeing that 18%. And definitely even that 11% has not translated into higher price of goods in the US economy yet. So there is no reason to cut rates, but rate cuts are coming next week. So markets will just celebrate on that.